Welcome to the deep dive. Our goal here is always to cut through all the noise, the information overload, and just get you the key insights fast. Today, we are taking a really close look at Broadcom Inc. That's ticker symbol AVGO. And our source material for this, it's a detailed financial and sentiment analysis report. It's current right up to today, July 21, 2025. It gives us this structured rating system for Broadcom, kind of a clear roadmap. But our job, well, it's to dig deeper than just the scores, right?
Yeah.
To really uncover what makes this company tick. What's its strategic pulse?
Absolutely. And Broadcom, it's such a critical player, a leader in, well, two really dynamic tech sectors,
Yeah.
semiconductors and infrastructure software. So this report, it meticulously evaluates their fundamentals, the strategic moves, and, where they stand in the market overall. It's really about understanding their unique position in this fast-changing tech world and what that actually means for their future.
Okay, so with that foundation laid, let's get into the story. Because the story of Broadcom's recent performance, especially its growth, it's pretty incredible. What's really driving this, particularly looking ahead? The report looks back, 2020 to 2024, but then it projects forward all the way to 2027. And what really jumps out is that the report puts a huge emphasis, like 80% weighting, on those forward-looking estimates.
Which is interesting, right? It's not just looking in the rearview mirror.
Exactly. It tells you the analysis is, well, it's betting heavily on management pulling off their strategy, on market trends continuing. It's kind of a bold stance, suggesting real conviction in where Broadcom is headed. And the fundamental shift, everyone points to it, it's that huge acquisition of VMware, closed in FY24. This created what the report calls a dual-engine growth model.
Like a hybrid approach.
Yeah, exactly. Think of it like, a high-performance hybrid car.
Yeah.
You've got the raw power from semiconductors, supercharged now with the smooth efficiency of software. So Engine 1, that's their top-tier semiconductor business, increasingly driven by, well, the stuff everyone wants. AI accelerators, critical networking gear.
Right. The AI angle is massive.
Totally. And then Engine 2, that's this formidable high-margin infrastructure software segment, thanks to VMware. Now, while FY24 saw that big jump, mostly from the acquisition, so inorganic,
Right.
the forecast actually sees organic growth speeding up.
Okay, so how are they doing that?
Well, two main things fueling it. First, they're successfully switching VMware's huge customer base over to recurring subscriptions. Predictable revenue, right?
Always good for the bottom line.
And second, they keep grabbing market share in custom AI silicon for those giant hyperscale data centers. The massive server farms powering the cloud.
So they're hitting the big trends.
Exactly. And the big benefit of diversifying into enterprise software, it makes their growth profile more resilient. It balances out the ups and downs you naturally get in semiconductors with that stable recurring software revenue. And if you look at the specific growth subratings in the report, some really stand out. Forecasted net income and EPS, earnings per share, they're projected to jump by over 26% annually. Both get top marks, 5 stars.
Wow, that's strong conviction in the earnings power.
It really is. The overall weighted growth score comes out at 4.25 out of 5. So that's a solid 4-star rating. Good, positive, strong, however you want to frame it.
And what's really fascinating here, thinking about what this means for you, the listener, is that Broadcom is pulling off this major strategic pivot. They're aligning directly with two of the most, durable tech trends out there, AI infrastructure and hybrid cloud software. The forecast really points to a new phase for them, sustained, high-quality growth built on dominant market positions. And, what the report highlights, maybe indirectly, is just how good they are at integrating something as huge as VMware. A lot of companies would stumble trying to run two such different businesses.
Yeah, that integration piece is key.
It is. Broadcom's disciplined approach, that seems to be a major differentiator.
Okay, so growth looks strong. But growth is one thing. How does Broadcom actually make money? Let's shift to profitability. The report really digs into this, looking at 2020 to 2024, and it reveals a lot about management's very rigorous operational discipline.
Right, the famous Hawk-Tan approach.
Yes, exactly. His acquisition strategy, it's legendary for its discipline. Take VMware, for example. The report notes, there was a temporary dip in margins in FY24. Integration cost, right, that happens.
Expected.
But Broadcom moved incredibly fast to extract synergies, to find efficiencies. They pushed VMware's segment margins from, below 30% towards 70%.
70%? That's impressive efficiency gains.
It's huge. This playbook, buy strategic assets, then rigorously optimize their costs.
Yeah.
It's not just a strategy for Broadcom. It's like their core value creation engine.
Almost a masterclass, as you said.
Yeah, Hock Tan's really turned it into an art. He keeps proving that even mature tech assets can throw off amazing profits if you manage them right. Plus, that shift to subscriptions for VMware customers, that's expected to boost the quality and predictability of earnings too, supporting higher profits long term.
Makes sense. Smoother earning streams.
Let's hit some specific numbers. Gross profit margin. Consistently way above the semiconductor industry average. Think 60.7% for Broadcom versus maybe 36% for the industry.
Big difference. Shows pricing power.
Absolutely. That gets a 5-star rating, even with that temporary FY24 dip. Then there's return on invested capital, ROIC.
Always a good measure of efficiency.
Yep. How well do they turn capital into profit? Broadcom's excellent here, consistently generating returns way above their cost of capital. Basically, every dollar invested brings back more than it costs. Also 5 stars.
Very strong signal.
Now, operating and net profit margins, historically great. They did wobble a bit in FY24 because of those acquisition costs, but the expectation is a sharp rebound. So overall, the weighted profitability score is 4.35, another strong 4-star rating. The report definitely paints this picture of elite profitability, which is, yeah, really impressive. But is there maybe a concern? Does relying so heavily on this playbook, this aggressive acquisition and cost-cutting, does that risk maybe stifling innovation down the line? Or maybe cultural clashes that don't show up in the numbers yet?
That's a really good question, and it's something, you have to consider. The report kind of addresses it indirectly, I think. If you connect the dots, despite those temporary acquisition impacts, Broadcom's underlying operational efficiency, it just stays elite. That points to a really strong competitive moat, a barrier protecting their business.
Right, hard for competitors to attack.
Exactly, and it says a lot about their incredibly disciplined management. The report suggests the VMware integration, it isn't just about getting margins back to where they were. It's about enhancing them, pushing them even higher. It solidifies Broadcom as one of the most profitable tech giants, really, precisely because they are so good at optimizing what they buy, but without, it seems, destroying its core value.
Okay, so strong growth, elite profitability.
Hmm.
Naturally leads to the next question. What about the balance sheet? Financial strength, especially after swallowing something as big as VMware. The report takes a pretty nuanced look here. Liquidity, solvency, cash flow, and yeah, it openly flags the significant debt they took on.
That VMware deal added a lot of leverage.
It did. But what's crucial is how the report frames that debt. It's not presented as just a weakness. It's seen as a deliberate part of Broadcom's strategy. They intentionally use leverage to buy these big transformative assets that generate a ton of cash.
A strategic choice, then.
Exactly. So yeah, traditional ratios like debt to equity, it's high at 1.10, looks weak compared to some peers on the surface. But the report argues this is, and I'm quoting here, a feature of its strategic model, not a sign of distress.
Okay, so what makes that argument hold water?
The cash flow. That's the critical context the report hammers home. The company's immense and reliable cash flow. That provides really strong coverage for the debt. Now, breaking down specifics, liquidity. Things like the current ratio, 1.17 in FY24, and the quick ratio. These measure ability to pay short-term bills.
Right, near-term health checks.
They have declined significantly after the acquisition, and they are below industry averages. So that indicates a tighter near-term position, and it only gets a 2-star rating.
Okay, so that's a watch item.
It is. But then you look at interest coverage. How easily can earnings cover interest payments? It's excellent. EBIT, that's earnings before interest and taxes, provided very strong coverage, 5.6 times in FY24. And the 5-year average is even better at 8.4 times. That gets 5 stars.
Very comfortable coverage, then. That offsets the liquidity concern somewhat.
It does. And then cash flow from operations to total debt and free cash flow to total debt, both are rated excellent. It shows their operating cash could basically cover all their debt in under 4 years.
Wow, that's fast deleveraging potential.
Exactly. Both get 5 stars. And the dividend. The payout ratio from free cash flow is also excellent. The dividend is very well covered, sustainable, another 5 stars. So putting it all together, the overall weighted financial strength score is 3.50. That earns a solid 4-star rating. Now, for a lot of listeners, maybe you included, high debt is just an immediate red flag. The report highlights the cash flow, sure, but are there scenarios where this leverage could become a problem? Any specific watch points may be hinted at?
That's absolutely the crucial point to weigh. The report tries to synthesize this nuanced picture by saying, look, yes, the balance sheet carries significant debt, but crucially, that leverage is well supported by elite, predictable cash flow generation. Broadcom's ability to comfortably pay its interest, pay its dividend, and still have substantial cash left over for paying down debt that fundamentally mitigates the risk.
So the key is just keep that cash flowing.
Precisely. The main watch point, as the report implies, is just maintaining that incredible cash flow engine. And historically, they've been exceptionally good at that. This really is the profile of a mature, super cash generative company that uses debt strategically for growth. And they've shown time and again they can manage that model very effectively.
All right, so we've covered growth, profitability, financial strength. Let's move from the company's internals to how the outside world sees it. How does the market perceive Broadcom?
The report dives into sentiment, and what it finds is pretty remarkable. It's like a unified bullish chorus. Everyone seems to be singing the same positive tune.
Really?
Yeah.
Unanimous. Almost. Starting with sell-side analysts, it's striking. 89% rate Broadcom a strong buy.
Yeah.
You just don't see that level of agreement very often.
No, that's incredibly high consensus.
This powerful consensus, it seems driven by two things. First, they keep beating earnings expectations. They've surprised higher in all of the last 4 quarters.
Consistent outperformance.
Right. And second, analysts keep revising their estimates upwards for both earnings per share and revenue. They're factoring in stronger AI demand and realizing maybe those VMware synergies are coming through faster than expected.
So the story keeps getting better in their eyes.
Exactly. It signals deep conviction. The average brokerage recommendation, the ABR, it's at 1.19. That's based on 37 analysts, and it gets a top 5-star rating. Now, price targets. The current price is around $288.52. The consensus target is about $298.55, so maybe 4% upside from here. Not huge,
Sure. Yeah.
but the high target out there is $400. That represents like 39% potential upside, so at least some analysts see significantly more room to run.
Right. Quite a range, but skewed positive.
Definitely. The overall analyst sentiment score is 4.3, another strong 4-star rating. Okay, now broadening out from just the analyst, what about general market and news sentiment?
How's the buzz?
Overwhelmingly positive, according to the report. Headlines are dominated by their AI leadership, record results, that successful VMware integration story. You really have to hunt for negative headlines.
Interesting.
That positive news flow scores a 4.60, clearly very strong. Then trader sentiment. It's also very positive. A key indicator here is short interest. How many people are betting against the stock? It's exceptionally low for Broadcom, about 1.2% of the float.
And how does that compare?
Significantly below the peer average, which is around 5.3%. The report calls this a profound lack of bearish conviction. People just aren't willing to bet against it.
Confidence, not speculation, then.
Seems like it. Options market data also suggests more balanced hedging rather than outright bearish bets. So the overall broader market and news sentiment score is 4.42. Again, a solid 4-star assessment.
Wow. So when you connect all those dots, the thing that really stands out is the significance of that unified positive sentiment. I mean, this isn't just 1 or 2 analysts being optimistic. It's this broad, overwhelming consensus that reflects really deep institutional conviction, belief in the strategy, belief in the financials, and that kind of strong, consistent tailwind from market perception. That can be a really powerful force for a stock. It helps the company keep executing its plans. It's actually quite rare to see such widespread agreement for a company this big.
Okay, let's pull it all together then. Summarize the comprehensive fundamental picture for Broadcom. The final overall company fundamental numerical score.
Okay.
Based on everything we've discussed, growth, profitability, financial strength, sentiment comes out at 4.09. That translates, once again, to a very strong 4-star overall rating. Good, positive, strong.
Solid conclusion.
Yeah, so recapping the core findings. Broadcom is clearly positioned as a best-in-class technology leader. It's got this exceptional forward-looking growth profile, really powered by those huge trends in AI infrastructure and hybrid cloud software.
The dual engines.
Exactly. And that's supported by an elite profitability model, industry-leading margins, and this proven, very disciplined ability to squeeze immense value out of the companies they buy.
Yeah.
And finally, yes, there's leverage on the balance sheet, but it's strategic. The risks seem well managed, mitigated by that just massive, best-in-class free cash flow they generate.
So the fundamental profile presented here, it's clearly that of a premier technology powerhouse. They're executing a very clear, very effective strategy that seems geared for long-term value creation.
Well, thank you for joining us on this deep dive into Broadcom. We really hope you've gained a more nuanced understanding of their strategy, their financial health, and how the market sees them. And as you reflect on all this, here's a final provocative thought to maybe chew on. In this era of just constant, rapid technological change, does Broadcom's success, specifically that strategy, aggressive M&A funded by cash flow, followed by intense operational optimization, does that represent a new blueprint, a new model for how mature tech companies can consistently create value?
Interesting question.
How might that model influence the future of the whole tech industry, especially with this massive build-out happening in AI and cloud infrastructure right now? Something to think about. We encourage you to reflect on that question and its broader implications.